Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing 2022 in about 3 minutes. Markets faced several challenges last year, including high inflation, historic central bank policy, the war in Ukraine, and COVID lockdowns in China. Inflation was a major factor, with the headline CPI reaching a 40-year high of 9.1% in June, prompting the Fed and global banks to aggressively raise rates and causing stocks and bonds to trade lower. Figure 1 shows the S&P 500 returned negative 19.4% in 22, its worst annual return since 2008. And Figure 5 shows the U.S. bond index produced its worst total return since 1976. It's important to remember that the markets has had 3 straight years of solid double-digit growth, and 1 down year out of 4 doesn't mean the train is off the tracks. This too shall pass. Figure 2 shows the speed and size of rate increases by tracking the cumulative percent change during rolling 3-month periods since 95. And as data shows, 22 was the quickest, largest, and most imbalanced global tightening cycle since the late 90s. That said, the pace of rate increases is forecasted to slow during 23, since price pressures appear to be easing and concerns that further tightening could push the economy into recession. While the U.S. economy contracted during the first half of 22, it expanded at a robust 3.2% annualized pace during Q3. Consumer spending remained strong throughout most of the year, and the U.S. labor market added more than 4 million jobs through the end of November, indicating the economy has withstood tightening thus far. While a recession is not a foregone conclusion as the impact of higher rates takes hold, it is possible the economy could be tested in 23, and there are no shortage of analysts lining up to make their opinions known. But we have a couple of opinions of our own too. First, if anyone can accurately predict what's next, they wouldn't be telling us about it. And second, markets typically recover before the economy, so it's impossible to time anyway. Note, there have been 14 recessions in the U.S. since the Great Depression of the 30s, and each one has lasted an average of 11 months. They are a natural part of the economic cycle, so stay patient, stay flexible, and stay the course. Outside of the markets, Congress passed new legislation known as Secure 2.0, which will have an impact on investors and retirement plans over the coming years. There are too many details to cover, but here are several highlights I'd like to share. First, the RMD age is immediately pushed back to 73 and will eventually go to 75. SEP and Simple IRA plans will now allow Roth contributions. Exceptions to the 10% early distribution penalty are expanded. The missed RMD penalty is reduced from 50% to 10%, but be aware, this likely means stricter enforcement. Unused 529 funds may be rolled over to a Roth beginning in 24. IRA catch-up contributions will now be inflation adjusted. And finally, 529 ABLE accounts will be more accessible to individuals with disabilities. So what's not in the bill? Nothing to prohibit the so-called backdoor Roth conversion strategy, nor any clarification regarding RMDs associated with retirement accounts inherited by non-spouse beneficiaries. So business as usual in those areas. Well, that's all for now. Don't let the naysayers distract you from your long-term goals, and let's make 2023 a great year.